How should you save when your income is limited? My name is Paul Vázquez with Tax Lab. We help people become ethical millionaires. Now, it's going to be a lot harder to become that ethical millionaire when you don't have a lot of income to begin with. While the services we provide directly are for those who maybe have a little bit of income to start with, the principles here can apply no matter what income level you are at. So, how can you take advantage of saving and investing the most advantageous way, given you might not be paid a lot of money to begin with? So I kind of work off of that third power system where we kind of want to divide things into three. So when you get that first paycheck for the year, I would look at that and say, okay, I want to save the rest. So they're not going to probably tax you. They're not taking out probably a third of your income right away for taxes. So you can add up your Social Security and Medicare and income tax on there. And if that makes a third of your income, then they've already taken that away. You would just divide the remainder in half. However, if you take that gross income, divide it by 3, and find they haven't taken off enough, you want to kind of reserve that third just in case you have a banner year. So that way you've got that ready and it's working for you along the way. So now you've got anywhere from 2/3 to a third of your income that you might want to consider saving. Now with that, you want a separate file, kind of a separate accounting of the tax portion, but then that other third that goes to savings, you want to kind of pair that into 3: short-term, mid-term, and long-term. Kind of your emergency fund, your big purchases that you're saving up for fund, new car, new home, and then the third is the retirement portion of that. Now, when we're contributing to a 401k, a IRA or a Roth IRA, we have a limit as to how much we can give per year. And it's around $7,000 at the time of this recording. So you have up to $7,000 as a bump up for age. If you're already past 55, then that's 50 years old. So if you're 50 or older, it's $8,000. So that's $16,000 for both spouses if you're both over age 50, or 14. Not 14. Yeah, 14,000. 7 plus 7. 14,000 if you're both under age 50. Sometimes my math brain and my public speaking brain don't always talk well. But that is still limited to your earnings. So when you begin a new year, that clock begins again. So you have to look, how much am I able to contribute in the first beginning? Can I contribute that full $7,000 or $8,000 per person in the marriage into these qualified plans right away? Is there enough in that first paycheck? Maybe not. Maybe you can only do that portion, but you want to get there as quickly as possible inside your qualified plan, right? Because that is compounding tax-free. So the growth on that is compounding tax-free. Now, if you're using a Roth strategy, and if you're under 150 as a single person, or it's a little bit higher if you're married, $236,000 if you're married. It bumps up, of course, if you're over 50. So that's the Roth phase out. So as soon as you earn that much in a given year, that whole year you might have needed to contribute to an IRA, not the Roth style. There's a Roth income phase out if you're at an upper level of income there. So if you're under that, you're probably saying, how can I get this in there? So you may want to take an approach where you put as much money into that Roth as you can during the year until you get up to that $7,000. And you just kind of earmark it in there. If you need some emergency money, you can take that money right back out in the Roth, up to what you've contributed for that year without the principal, without having any penalties. So it can act as an emergency fund savings account that way, with tax-free interest. So that means no 1099 form at the end of the year coming off of that. So there's a lot of benefits there. So I would first make sure you fund that if you've got more money left over after these paychecks come in, because you have to keep it. So if you earn $5,000 a month, if you earn $2,000 a month, you can only contribute up to what you've earned into that. But you kind of want to focus on that first, because once again, that's tax-free growth that you can get into that account. So focus on that first. Once you got up to the max for the year, then you might begin to contribute to a short-term account and a mid-term account separately. And so you'd want to probably try to keep track of how much is there. Now, hopefully you don't have any emergencies during the year, and so it might be easier just to begin to, after that first $7,000, try to see if you can get $7,000 into each one of the other accounts through your savings throughout the year. But once again, it's kind of limited to your income. You don't necessarily want to prevent yourself from living a healthy life. So health is the optimal goal, right? If you can live in luxury, great. But you don't want to necessarily be putting yourself in imminent danger just to try to save some money. So you kind of want to take care of the basics first. Make sure the basics are covered along the way. And so you still want to divide that money out, still utilize those accounts, but then if the emergency does come, of course, that money can be available even in the Roth. So I would actually aim for that first. Aim for maxing that Roth IRA first, and then look at putting into other accounts that don't get tax advantaged when it comes to savings. If you want a plan that works directly for you, specifically for you, go to lab.tax, click on advisory services, get a comprehensive consult. The first 15-minute introductory phone call is free, and then we'll decide if we can put together a plan for you, if it'll be advantageous. I wish you guys all the success.